What's up, everybody? My name is Joe Brown, and this is Heresy Financial. It seems these days that everywhere you turn, you're seeing another economist, another analyst saying, hey, the housing bubble is about to pop. We're about to see some devastation. The housing market is about to collapse. Prices are going to start falling dramatically, and it's been this way for about 10 years. But more recently, one of the areas that people have been focusing on is the number of mortgages that are in forbearance and the coming tsunami of foreclosures as a result of all of these forbearance plans coming to an end, people not being able to make their mortgage payments anymore. So today we are going to look at the actual numbers. We're going to see if there's any validity to this claim, to see if there is any coming housing collapse, seeing if there's any catastrophe right around the corner that we need to pay attention to as real estate investors. Ready? Let's dive in. Just in case you're not aware, the definition of heresy is an opinion or belief that is profoundly at odds with what is generally accepted. And right now, it's no secret that what is generally accepted is that housing prices are too high, we're in a housing bubble, and it's just a matter of time before we have another crash like we had during the Great Financial Crisis. But instead of just looking at the fact that prices have gone up, because prices are no indication of a bubble, you need to look at supply and demand to have any indication of whether a bubble exists or not, because prices can be manipulated up or down via central planning. So let's look at the actual numbers. First, let's look at this infographic from Reuters about a poll. They polled 102 analysts about the biggest downside risk to housing markets over the next 12 months. So these aren't just your average people, but again, they don't have a crystal ball. In any case, they said that the higher interest rates or tighter monetary policy would make up the bulk of the biggest downside risk to housing over the next year. This is important because what are the chances of tightening monetary policy over the next year? I think they're extremely low. I've been talking about this for a while, but the first thing that will happen would be a taper of asset purchases. So the Federal Reserve is purchasing at least $120 billion worth of assets every single month. This is called an easy money policy. It injects money into the system by withdrawing those assets, specifically mortgage-backed securities and treasuries, from the financial system. And so it makes it easier to get your hands on money. And so that is a policy that they're currently talking about winding down. Instead of $120 billion, maybe they drop it to an unspecified amount at this point. We just got news last week that the Federal Reserve is probably not going to be able to taper their asset purchases as soon as they thought they were, specifically because jobs are not where they want them to be. And jobs is basically all that the Federal Reserve is looking at. Whatever happens with inflation, they'll ignore. Jobs is what they're looking at. After they accomplish tapering their asset purchases, that's when they'll start to look at raising interest rates. And housing specifically is one of the most sensitive areas to interest rates. And so this is important that if one of the biggest risks to the housing market is tighter monetary policy, and interest rates are going to be the driver of that, we do not see higher interest rates on a short-term time horizon whatsoever. And even if they do start happening, it's going to be extremely slow and incremental until it triggers another economic crisis, in which case they're just going to reverse and do a 180 and go back the other direction. All right, the next thing that we're going to look at is forbearance numbers, because this is one of the key numbers that people are looking at and saying, hey, all these people out there can't pay their mortgage. The only reason they're still in their house is because they don't have to pay their mortgage. And as soon as that comes to an end, it's going to cause a massive housing collapse because all these people are going to be selling their houses. They're going to flood the market with inventory, push prices down. Well, how many people are in forbearance? First, let's look at 1 year ago, September of 2020. In September of 2020, 1 year ago, the percentage of mortgages that were in forbearance was 7%. That's high, not astronomical, but that's high. So where are they now? Well, consistently every single month, the number of mortgages that have been in forbearance have been dropping to the point where right now we're at 3.25% of all mortgages in forbearance. Everybody's ending their forbearance plans because guess what? Everybody was just doing it because they could. Sure, there were a lot of people, it was a lifeline for them, and to not have to pay that mortgage every single month provided them what they needed to get through the last year and a half. I'm not discounting that. What I am saying is that there were also a lot of people who did it just because they could, and it gave them some extra juice. Even if they didn't need it, it helped them out. And so now that those plans are coming to an end, people are just starting up their mortgage payments again. They're working out deals with, depending on the type of mortgage that they have, they're able to work out a payment plan, they're able to pay it all back in one lump sum, or they're kind of doing like the refinancing, extending the mortgage another 40 years to lower their total payment, working out deals. They're happening all over the place. And this is key because this is one of the main factors that everybody has been saying. As soon as these forbearance plans start coming to an end, we're going to start getting a ton of supply hitting the market because nobody can afford their mortgages, so they're just going to have to sell their house. Well, it turns out that's not true. We've had a collapse in the number of mortgages that are in forbearance, and guess what has happened to supply? Nothing. To put that 3.25% into numbers, that's 1.7 million homeowners that are currently in forbearance, because all mortgage holders are homeowners, but not all homeowners have a mortgage, and so that's 1.7 million. Now, remember what I said earlier about supply and demand? What would happen if all 1.7 million of these homes that still have mortgages in forbearance, let's say every single one of them was somebody that could not pay, they ended up foreclosing, they ended up selling their house, and all that supply hit the market all at once? Well, two things. Number one, they're still going to have somewhere to live, right? Whatever negative impact that has on the housing market in terms of the prices of homes, that's going to have somewhat of an upwards effect on rental demand, which will put rent prices up. And right now, at the current population, current demographics, we're about 3.8 million homes under what we need to support the demographics, to support the population in this country. So even if all 1.7 million all at once, that would still not be enough to satisfy how far behind we are in terms of how many houses there are for the number of people that want houses. In fact, an analysis done by Home LLC for Fortune forecasted that the end of mortgage forbearance, if all the homes in forbearance right now were put onto the market to be sold, it would only cause a temporary 11% rise in supply. Okay, so at this point, you're looking at the forbearance numbers and you're saying, okay, these forbearance numbers are coming down, but what are foreclosures doing right now? Well, let's take a look. And we have to look long term to put these numbers into perspective. At the height of the financial crisis in 2010, foreclosures hit 2.23%. In 2019, that was at 0.36%. We've had a consistent downtrend since then. Now, this is probably not surprising given all of the assistance to homeowners that came out during 2020, but obviously we had a very low reading in 2020 at 0.16%. This means that by the end of 2021, what will likely happen is we're going to have much larger foreclosure numbers than we had in 2020. But it's very important to look at this in light of the last 10 years, because 2020 is going to be the rock bottom. So if we have an up year after 2020, that's to be expected. So what do the foreclosure numbers look like during 2021? Well, we have to keep in mind we haven't finished the year yet. So any numbers we have don't account for the entire year, obviously. And this is important, we are the end of the year is likely going to be worse than the beginning of the year because we're having the assistance drop off, we're having the forbearance plans end, and so the end of the year is likely to be more severe than the beginning of the year. With that in mind, let's take a look at the first 6 months of 2021 versus the first 6 months of every year prior. The January to June foreclosure activity for the first half of the year in the US is dramatically lower than 2020 so far. And we already know 2020 was a historically low year for the number of foreclosures. Now, I need to stress this point because I don't think it's being stressed enough by anybody. If we do have a wave of foreclosures, it won't be enough to satisfy the demand. If you take a look at all the homeowners who are at risk of foreclosing, if you make the worst assumptions possible about the economy going forward, we do not have enough people who will be selling their homes to satisfy the demand. The demographics and the situation today is vastly different than what it was going into the Great Financial Crisis. In the 8 years leading up to the Great Recession, home builders were averaging 1.7 million homes per year being built. But from the years 2013 to 2021, they've averaged only 1.2 million homes per year. And from the years of 2009 to 2013, they were barely cracking over 500,000 homes a year. So while housing inventory has gone up recently, it's much easier to find a home for sale right now than it was, let's say, January of this year. It's still nowhere near what it's been historically. Another key difference going into 2008 was the affordability. And you might think that's crazy. Homes are way less affordable now than they used to be. That is actually not the case, all things considered. Number one, interest rates. Number two, income. When you compare apples to apples, going into 2008, on average, 7.2% of U.S. personal income was going towards their mortgage payments. This year in 2021, it is currently at 3.4%. And if we take a look at the ratio of houses for sale versus houses sold, we can see we are very, very average in this nice happy medium right now. In fact, almost exactly at a happy medium. Since 1960, we've been right in between 5 and 7 in terms of where this ratio normally is. The number of houses for sale versus the number of houses sold. Anytime you get above 7, you start to get peaky. It usually happens during recessions. And anytime you get under 5, that's usually a time when there's a very low supply. But in between 5 and 7 is the happy medium. And we're right at 6.2 right now. And lastly, I'd like to look at homeowner equity. This one is important because let's say something does happen that causes house prices to completely collapse. Let's say tomorrow, Jerome Powell comes out and says, hey, we're jacking up interest rates to 10%. And not only are we stopping our asset purchases, but we're actively going to start selling assets off of our balance sheet. Well, homeowner equity is very important simply because if nobody has any equity in their homes, then everybody is underwater and home prices will start to have that death spiral where it'll start to spiral because everybody starts selling, and then that prompts further prices to be depressed, and that prompts more and more selling because everybody's underwater. Same thing that happened 12 years ago, right? Well, homeowner equity is fantastic right now, especially in light of going into 2008. This data that I'm showing you is through Q1 of 2021, which means that the current reality is even better than this data. CoreLogic shows us that homeowners with mortgages have seen their equity increase by 19.6 year over year. Further than that, the number of mortgaged properties that had negative equity decreased by 7% from the fourth quarter of 2020. Percentage-wise, that's only 2.6% of all mortgaged properties. In dollar terms, during the first quarter of 2021, the average homeowner gained $33,400 in equity during the past year. Some of the places with the biggest increases were California, Idaho, Washington at $70,000, $71,000, and $66,000 respectively, and the lowest is North Dakota coming in with $8,000 of increased equity. So homeowner equity is in a place right now that even if we do have a catalyst for a big drop in housing prices, we have a long way to go before most mortgage holders are underwater on their homes. Summary. The biggest risk to the housing market is tighter monetary policy, both from tapering asset purchases and from rising interest rates, both of which are going to be delayed longer than most people expect. And the worst of those, which is higher interest rates, is going to be delayed the longest. Second, mortgages that are in forbearance have been quickly falling to the point where only 3.25% of all mortgages are in forbearance right now. That is 1.7 million homes. Despite the fall in the number of forbearance plans that are active, we have not seen an uptick in foreclosures. In fact, we've seen a drop from the last year, 2020, which was already at a record low. Part of the reason for a lack of forbearance plans turning into foreclosures, contributing to an increase in supply, is because of the increased affordability due to lower interest rates, refinanced mortgages, and higher incomes to mortgage ratios than we've had in the past. Further than that, any supply that is hitting the market is getting soaked up by buyers because there's much more demand for places to live than there are places to live in the United States right now. This is because home builders took a decade off because they were burned after the financial crisis from building way too many homes, losing a ton of money, and now we're at a place where about 3.8 million homes behind schedule, again, compared to the number of people who want somewhere to live. And even if some things happen that would catalyze a drop in housing prices, despite the supply-demand mismatch, you have to fall a lot before even the newer home buyers start to experience a drop in their home value past the point of their equity that would get them to the point where they're underwater. At the end of the day, I'm just some guy on the internet, so don't take my word for it. Do your own research. And if you are looking for a way to get into real estate, one of my favorite ways to invest right now is with Ground Floor. They're the middleman between people who want to borrow for real estate development, like they want to do a fix and flip, something like that, and the person who has the money and wants to lend on that and get a high return on their money because you can't get anything in the bank, get 10, 12, 14% on a real estate loan that is backed and collateralized surprised by the property that's being worked on. It's one of my favorite ways that I'm using to invest in real estate right now. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.